Hello, hello. Got an interesting shadow there. Let me get rid of that. All right. Welcome to the presentation. Thanks for joining. We've had a lot of questions about what's going on with the interest or with the real estate market right now. People are asking a lot of questions about what's happening with Silicon Valley Bank and how's that going to affect financing in Canada. And I wanted to explain a number of different things, as well as some observations about what's happening in the marketplace and where I think things are heading. So the question I'm posing today is it time to buy real estate again? It was pretty apparent that last year was not a great time to buy real estate. Interest rates were starting to rise. Valuations were still quite high. And now the question is, with everything that's going on in the world, with interest rates starting to come back down a little bit, with valuations having come down a fair bit over the last 12 months, is it time to look at buying real estate again? So thanks for joining us. I'll be talking about a number of different things today. We're going to start off by going back a little bit in the past and talking about what a roller coaster it has been since COVID hit. It really has been a crazy, I guess it's been 3 years now, since March 2020, when I still remember that Friday when interest rates with many of the lenders are all of a sudden starting to skyrocket because of the basically because of Canada and US and other countries starting to just completely shut down. So it has been quite a roller coaster. We went from nothing happening in the real estate market to it being a gangbusters market to all of a sudden being a very quiet market again as of last year. And so we're going to be taking a look at, is it the time to buy? And there's a number of different factors that are at play here. Interest rates in the financial markets is a big one. And this is the primary reason I wanted to put this together, is actually because there's been a lot of movement and questions about the financial markets. I wanted to address that and be able to discuss how that would impact interest rates and impact real estate. I'll talk about the real estate market in general. Obviously, real estate is very localized in nature, and so it's hard for us to give very specific items that are pertaining to any specific marketplace. But I do want to talk about general observations that we're seeing in the marketplace. And one thing that I don't think a lot of people are familiar or understanding right now is that there's a lot of potential rule changes that are on the table, in particular for real estate investors. And you want to talk about what some of those potential changes would look like and how it may impact you, especially if you're looking at investing in real estate. So let's, of course, talk about the interest rates. Everyone wants to talk about interest rates, so we're going to start with that and really go into detail. Looking back, let's talk about what happened, because the government of Canada and, of course, many other governments in the world were really focused on a couple of different things here, which was, are we going to raise rates slowly, risk inflation and reduce a recession, or are we going to raise rates quickly, combat inflation and risk a recession in 2023 and 2024? Apparent that this is not what decision the Bank of Canada chose to do, and rates rose quite quickly in order to combat inflation. And even though they raised the rates very quickly, they still were not able to combat inflation. And so we really put the country into a bit of a risk of recession in 2023 and 2024. Generally speaking, the higher and the faster the increased interest rates, the more that the economy is going to slow down, and the higher the likelihood that we put ourselves into a bit of a recessionary period. And so this is pulling up a 5-year bond chart to discuss and showcase how interest rates have changed over the last little while here. And obviously interest rates have risen considerably. This is the 5-year bond yield. Obviously during COVID, it was very, very low. Then we had the $50 billion bond sell-off, which popped rates up a little bit. Omicron, which actually caused the rates to come back down again. Ukraine, the war in Ukraine had a pretty large impact on inflation, which then had an impact on fixed rates. And so we actually saw that rates came down and then shot up again. And then something called quantitative tightening. And this effectively is the opposite of what the government was doing when COVID hit, which was printing money. And instead, they're basically taking money off the table. And so the reason that I have this chart up here is that fixed mortgage rates are very highly correlated with bond yields and bond rates. If you see bond rates moving up or down, then you're likely to see fixed rates actually move up or down as well. So we've seen that the fixed rates have come way up since COVID. They were probably somewhere around 0.4% for quite some time during COVID. And as of late last year, they were about rising up to about 3.75, 3.8%. So that's not where things are at right now, but that's where things had been moving up towards. Now, of course, we had a very large recent change in impact, and that was with SVB is the primary concern here, which is the Silicon Valley Bank down in the United States. And so let's talk a little bit about what happened there. There's a number of different impacts and things that affected Silicon Valley Bank. So first of all, it's important to understand who Silicon Valley Bank's customers were. Most of them were startups. And a lot of these startups had a lot of cash, more cash than they've ever had before. In a low interest rate environment, a lot of money floods into investments like startups, investments that they may have a higher failure rate, but if they take off, may have a really, really good return. In general, the lower the interest rates, the less people are looking at risk, and they're really just trying to place their money and get it moving and mobilized for them. Now, one of the things that has changed, of course, over the last 12 months is it became a little bit harder for these companies to raise cash. And so instead of these startups having an excess of cash, all of a sudden they're starting to dip into their cash reserves. And so there's a bit of a net withdrawal with those customers. So they're starting to pull out their money. So the bank used to have a ton of cash sitting in the bank, and now that cash is decreasing. On the flip side, on the asset management side of things, it's interesting because to a bank, cash is a liability because they have to repay that money back. And so what the banks did is they purchased mostly 10-year treasuries at about 1.5% to offset the liability, which in itself is not necessarily a bad move. They're taking that cash and saying, okay, let's invest the money into safe assets that have a solid return. 1.5% isn't that bad when all those deposit holders are parking their money at 0.1% in the bank account. But something very interesting happened, and the market changed very quickly. Interest rates rose very, very quickly, more quickly than most people expected. And what ends up happening is if you park too much money into long-term assets like bonds, and then the interest rates start to rise too quickly, it actually devalues those assets. And so if you have a lot of money parked in those 10-year bonds and then interest rates rise, and now you can get a return of, let's say, 4.5% by buying a bond instead of 1.5%, well, why would somebody buy your bonds instead of somebody else's that are paying a much higher return? So the value of those assets decrease. So what's happening here is the customers are now having to withdraw more money. And in order to meet that withdrawal demand, they had to sell off assets. And even though there are assets on the table, they had to sell them at large discounts. And what ended up happening is there's a large trigger where they had to sell a number of them off, and they lost about $2 billion. And then actually went to the market and said, okay, no worry. We lost some money on these assets. It's not a big deal. We're just going to go out and raise a bit more money and everything's going to be okay. And all of a sudden, people start panicking and there's a bank run. And it's that classic bank run where there's a lineup of people at the door trying to get their money out. Nobody wants to be the last one holding the bag. And so it's an interesting thing here where in general, if you look at a large bank, usually they stagger their assets so that no matter what, they always have assets that are coming up for renewal very soon. And so if they have staggered their assets into 1 year, 2 year, 3 year, 4 year, and a nice curve all the way up, then they probably wouldn't have had to take such a loss to sell off a lot of their 10-year treasuries, which are the ones that had the largest losses because it's still 9 years ticking away at only 1.5%. Or if they had a lot of ones that only had 1 or 2 years remaining, then the value of those assets would have been very similar to what they were worth when they bought them. So that was one of the major issues. And so I think one thing that people don't understand is that stacking of all of those assets and making sure that there's a renewal coming up every once in a while on those assets, because it just allows them to have that liquidity over and over again if they need to have liquidity, as opposed to just pumping a ton of it into 10-year treasuries. So we had a bit of an interesting situation. Silicon Valley Bank all of a sudden had a failure. Signature Bank and Silvergate as well also had failures. And Silicon Valley Bank and Signature Bank were now actually the number 2 and number 3 largest US bank failures ever in the history of the United States. So this is a pretty big deal. What ended up happening is the government stepped in to guarantee depositors money. And shortly after that happened, all of a sudden Credit Suisse were starting to have some issues, and they really have had some issues for the last 5 or 10 years. But all of a sudden their situations got exacerbated, and the Swiss government stepped in and actually orchestrated a purchase over this last weekend where UBS is now buying Credit Suisse. And I don't think UBS really wanted to buy Credit Suisse, but in order to facilitate the trade, the Swiss government actually issued UBS a massive $100+ billion line of credit in order to help with them purchasing Credit Suisse, which is very interesting. Now, all of this is happening, and what's happening is money is now flooding to safety. So it's not about trying to get a return on your capital, it's just trying to get your capital returned, period. And so money typically flocks to safety. And when that happens, bonds and other assets like bonds are generally considered a pretty safe asset. And so we actually saw that over the 3 days there where Silicon Valley Bank, Signature Bank, et cetera, were failing, we actually saw the largest decrease in bonds in about 40 years since the early 80s. I think it was 81 or 82 was the last time that we saw such a big decrease. And so going back to that bond chart, now bonds have dropped considerably, and I'm taking just from October of last year until today. We saw a couple of things that were moving interest rates. So overall, interest rates are starting to come down, as it seemed like, in particular in Canada, we're really starting to get the inflation under control. And that's where we saw that interest rates started to decrease back in January there. So the Bank of Canada said, hey, we're increasing the rate by a quarter point, but we're unlikely to see any more increases. We're going to pause interest rates. However, those rates decreased quite considerably. And then US inflation and their CPI numbers, so their core inflation numbers, popped up, and they were really strong. So all of a sudden, we saw the interest rates started to climb back up again. However, we then saw some bank failures, and this is where we saw that massive decrease over a very short period of time. And what this means is that all of a sudden fixed rate mortgages are starting to get better priced again. We're starting to see that 3-year fixed rates and 5-year fixed rates with certain lenders are again underneath 5%, which seems to be a bit of a trigger point in marketplaces. So Bank of Canada, over the last couple of years, well, I guess a year and 3 months, they've raised the interest rates 4%. And these are the first increases that they've had since 2018. You can see that they've increased the rates considerably, and their last hike was on January 25th when they hiked 25 basis points to 4.5%. In their early March meeting, they decided not to move their interest rates as they had described and had mentioned on their in their January meeting, and so no change in March. Another question is, they've currently paused, but there's also some people pricing in a chance that they're going to go down this year. So some of the more aggressive traders are predicting that interest rates may actually go down for prime as early as July. I still think personally myself that I wouldn't bank or bet on that. I still think that it would be early 2024 before we start to see decreases. But even before the Silicon Valley Bank situation, there were some people pricing in a chance that in the October meeting, so late in the year, the Bank of Canada might start to consider decreasing interest rates ever so slightly. So that question of will rates go up or go down, we really are watching what's happening with inflation, and inflation really has been coming back down, and it seems to be getting under control, which is an important factor. But it really is going to be inflation versus some of these other market situations that are happening right now. And if inflation continues to drop month after month, then we'll be more likely to see interest rates decrease sooner rather than later. But it's going to be a bit of a wild ride, and we know that in speaking with some of the high ups. In fact, I had a meeting last week, and one of the financial planners that I'd sat down with had lunch with Mark Carney, who used to be in charge of making all of our monetary policy decisions with the Bank of Canada not too long ago, before he went over to the UK to manage their country. He had mentioned, hey, you know what, we're as a country, we're unlikely to decrease the interest rates too quickly. We're probably going to just want to keep it the same and just really let the inflation die down to that target number, which is about 2%. I have a feeling that maybe the Bank of Canada will be comfortable at something closer to about 3% for a short period of time and start to decrease the rate slightly. But it does seem like the inflation is a very scary thing and a very real thing for central governments. So what's happening right now, and where the predictions are heading, it seems like on the fixed rate side of things, expecting flat to perhaps even slightly decreasing interest rates as we get closer to the end of the year. And the prime rate, still up or flat. There's still some talk that they might increase the interest rates by 0.25% at some point in the next little while. It does seem, however, that they're not very likely to increase interest rates, and so my prediction is that they'd probably be sticking closer to that 0% and probably not moving at all. And depending on how this whole SVB thing pans out, and if there's more systemic risk and problems in the marketplace, we might see the interest rates start to actually decrease later in the year, anyways. Now, what does this mean for a borrower? Now we're starting to see some of the short-term fixed rates are again getting down to that 5% range. Now, we are in an interesting environment right now where the long-term fixed rates are actually lower and cheaper than the short-term fixed rates. So if you're getting a 5-year fixed, then the rate is even lower than a 3-year fixed. So we are seeing some lenders that are offering competitive 3-year fixed rates. Not every lender. Some lenders like Scotiabank, for instance, seems to be quite uncompetitive, and that's due to their new CEO saying, hey, you know what, our interest rates have been too good for too long. They're actively trying to decrease and unwind their mortgage book a little bit by having interest rates that are quite high. So if you do have a renewal with Scotiabank coming up soon, or if you're looking at locking in from a variable into a fixed with Scotia, in general, if you're trying to lock into an interest rate with Scotiabank and the rate that you're getting offered, or I should say with any bank for that matter, they're offering you 5.5% or higher, then that's usually a good sign that even if you break your mortgage and pay a 3-month interest penalty to move to another lender to get a 3-year fixed rate of, let's say, 4.99%, it's actually in your favor to do so. So that is something to consider if you're thinking about maybe locking in, especially if your variable rate mortgage is, prime minus 0.5% right now, and you might be at, 6.2% or so, then that could be quite high. I should actually clarify too, the prime rate has moved up to 6.7%. So it's actually 6.4, because I think this slide I had accidentally reused, and that was from right before the January meeting. So as of right now, most lenders are prime minus 0.3, which is 6.7 minus 0.3, which is 6.4%. Another thing I want to talk about is the real estate market itself, and what we're seeing. There's a lot of talk about what's happening in the real estate market, but in general, in most urban centers, this is the sentiment that we're starting to see, which is that real estate values seem to be hitting a bit of a floor in many markets. At least the decreases are not continuing to happen, and I do think that we have to be very careful about watching this. It may not be the full-time floor. Maybe this is a short-term floor, and then maybe things continue to drop at some point in the near future. But it does seem like at least in January and February, most markets have recovered and we're not decreasing any further. One of the observations that we're finding is in many urban centers, developers are choosing to delay their projects, and in some cases, this is over 50% of developers that are asked this question are delaying their project. And so this means that it's not affecting the supply today, except for pre-sales, but it is going to affect the supply in the next couple of years. And already, as of today, we're in a very low supply market. In Vancouver in particular, in Toronto, et cetera, the supply in these markets is very, very low. And it's actually not that far off of where we were at back when COVID was a major factor, and interest rates were very low. Except at that time, the demand was much higher. So we're in a low supply, low demand market. However, there are many factors that can affect the demand and the demand changing. One of those factors is if interest rates have dropped a little bit, and if they continue to drop, then that's going to push up demand a little bit. Another factor is the immigration policy. Last year, Canada welcomed over 400,000 newcomers to Canada, and their targets is to welcome 465,000 people in 2023, 485,000 in 2024, and 500,000 people in 2025. And these people are going to need places to live. So if you have developers choosing not to build new property today, and you have a huge influx of people coming into Canada, then where are those people going to live? And we've actually already starting to see that it's affecting the rental market a little bit. If we look at what's happening with the rental rates, they're up about 15% in many major urban centers. Looking at this chart here, Vancouver, depending on whether it's a 1-bed or a 2-bed, is up by 15 to 22%. Toronto is up by about 20%. Burnaby up by 15 to 30%. Oakville, Ontario, between 15 and 20. A lot of those urban centers have seen major increases to the rental rates, and so this is a concern and this is an issue. And what we're going to find is that in general, in real estate, it always comes down to supply and demand. And we're finding that if the supply is being pressed down and suppressed, and eventually we start to see the demand starts to increase due to interest rates, due to immigration, and et cetera, we're going to find that we're going to have more people needing places to live again. And if we see interest rates drop and we see that the supply is quite low, then we're actually hearing some economists predict a little bit of a mini boom in 2024 or 2025 again, when people are starting to look at places to live again. So this is an important thing to consider and think about. So I'm just going to turn on some light here. Now, I do want to factor in and talk about another important thing that that isn't really getting talked about a lot, and that's primarily due to rental property financing, but it is just in general on financing. But the money is starting to dry up a little bit, and the down payments are possibly going to be going up. So there's a number of different changes that are coming down, and this is probably one of the most concerning ones, and I'll get into detail about why that's the most concerning. But on rental properties, and in particular for real estate investors, this is one change that is coming down the pipeline, and this is coming down in June, although we haven't heard much news on it since they announced it about a year ago. But there's a couple of things that are coming up, which is that if you have a mortgage or a HELOC product that either you're acquiring or is coming up for renewal in June or afterwards, then only 65% of the value of the property can be readvanced. Okay, so that means that if you have $1 million home and you're getting $800,000 mortgage, then 15% of the value, so $150,000, is going to be a mortgage that, as you pay it down, will not add to your line of credit limit. But the $650 portion, as you pay that down, it will add to your line of credit limit. So it's a bit complicated. You can still borrow 80% financing on your home, but only 65% of that value will actually be adding to your line of credit limit over time. So effectively, what the government's trying to do is to say, hey, look, you can still borrow up to 80%, but we don't want you to be able to use your house like an ATM going all the way back up to 80%. We need to see that you pay it down from 80 down to 65, and then once you're at 65 and lower, then as you pay it down, you can reborrow money. So if you are one of these customers that are looking at wanting to buy in a rental property and you need access to as much capital as possible, then if you're able to redo this mortgage before June of this year, which is coming up pretty quick, then you may be able to still get a product where you can readvance up to 80% of the value. And then your renewal will come up in 5 years from now, and that's when it will be reevaluated again. So if you don't do this and maybe your renewal comes up in a year, then now you're going to have to restructure the loan and have less of it be readvanced and basically less access to capital. So this is something that is coming down the pipeline. However, the banks have not given us a lot of information and detail about exactly how that's going to get rolled out. A couple of things that we know are on the table for consideration, which are all quite concerning. The first one is on rental income, and so what's called a rental offset is getting starting to get swapped out. A rental offset is a better method of using rental income, and the government is really wanting on the subject property, so the property that you are financing, they really want the loan to be evaluated and based off of what's called an add to income basis. Now, really what this means is that if you had $1,000 a month in rental income, many lenders will use an 80% offset on your other properties in your portfolio. And that means that they take $800 and they offset all the expenses. So you get to use the $800 out of the $1,000. Now, an add to income method, often they say, well, we're going to take 50% of the rental income, so $500, add it to your income, and they usually only want about 44% of your income to be used towards servicing your debts. So the 44% of the $500 is only $220 a month. So it really has a large impact on the amount that you can qualify for. And we've already started to see many lenders change their policies and only use the add to income on a rental property that you're financing. So it is getting more and more difficult to find lenders that will use a rental offset on the property that you're purchasing, and this can have a large impact on your borrowing power. Another thing that's been on the table for quite some time now is increasing the down payment on rental properties. And there's some talk about this increasing to 25% or even 35% down on rentals. And this will have a massive impact on the ROI on rentals. If we look at it and we look at you buying a rental property 20% down versus having to put 25 or 35% down, then you're going to see that your return on investment, if all other things are equal, your cash flow is going to increase a little bit because you're putting a larger down payment, but your return on investment is going to decrease from about 18% down to 16% if you have to put 25% down, and down to about 13% if you have to put 35% down. And this is probably the biggest concern and an issue that we have on the table right now, is that if you have to put a lot more down payment down to buy a rental property, it's going to take a lot of investors out of the market, and at minimum, it will reduce your return on investment. The last one I want to talk about is what's called LTI and DTI, and these are loan to income and debt to income ratios. So the government is looking at introducing some loan to income and debt to income ratios, and basically debt servicing means they're always looking at what the payments are. And so as interest rates go up or down and the stress test rate goes up or down, the amount that you can qualify for changes. So back when the interest rates were very low, it required about $20,000 in income per $100,000 that you're borrowing. Now that interest rates are higher, it requires closer to $25,000 of income per $100,000 that you're borrowing. Now, if you look at a loan to income ratio, the number that they've thrown out in the past has always been around 400 to 450%. It basically means that in this case, you need probably about $22,500 of income per 100 grand that you're borrowing. And so somewhere in the middle, but as interest rates start to decrease again, back to what would be called more normal levels, I think that we're going to see that people will actually qualify for a little bit less. And the biggest issue with this is that they're not clarifying whether this is for all of your portfolio or whether this is going to be for just a singular property. And what I mean by this is that let's say you have 5 rental properties. Well, that loan to income ratio and debt to income ratio, that's really, really difficult to meet if you have a number of different properties. And so there is some concern and consideration here that the government might not want a number of different people qualifying for way too much residential debt. They're very concerned about it, and they really are starting to discourage it. So based off of all this information and what we're seeing with a general tightening in qualifications coming soon, and we again don't know exactly what's going to happen, but I do, based off of the previous ways that they rolled these out, they often will come out with this and make this a very quick change and say anybody that already has a contract in place is grandfathered, that anybody that is buying something now will have 2 weeks or 4 weeks or whatever to find a property and move on it. So this can happen very quickly and may give us very, very little notice. But my prediction is that if we fast forward a couple of years from now, I expect that we're not only going to see a higher demand because interest rates will be falling, but also we'll have a lot of immigrants wanting to buy a home. And it usually takes them a couple of years to settle in and then look at wanting to buy a home. For an immigrant moving to Canada, it's a very important part of moving here is to achieve home ownership. And so we do expect that a large number of those new to Canada incomers will want to be able to buy their own home. And so if you have a lot of demand coming up and you don't have a lot of supply coming online because people are pausing their projects as of today, I think we're going to have another supply shortage in a couple of years with an increase in demand. So I expect that we're going to see values increase again in a few years. Another thing that I expect will happen too is that because it's getting harder to qualify for residential mortgages, we expect that there's going to be more of a push towards commercial mortgages. What I mean by commercial is anything except 4 or less residential units. So 5 or 6plex, for instance, you can get a CMHC insured multifamily mortgage on that property. And CMHC actually changed some guidelines last year where, depending on the property, it's possible, and it's typically on brand new, but not always, you can get up to a 50-year amortization. Yes, 50 years. You can get up to 95% financing. Yes, up to 95% financing, which again is very, very rare, but doable. And if you are buying a large building, like a $10 million building, the interest rates are often in the low 4s as of today. And so lower interest rates than residential lending, longer amortization, and higher, potentially higher loan to values. And so I expect that instead of seeing individuals buy small residential properties, I expect that we're going to see more people grouped together and then buy large apartment buildings as a group. I expect more joint ventures, et cetera. So we'll see what happens. But based off of what we're seeing, I'm observing that we're very, very busy with a lot of commercial loan applications right now, busier than we are on our residential side of things, and I expect that trend will probably continue into the near future. One other thing I want to showcase really quickly here is we are developing a tool that is allowing us to underwrite and assess a borrower's qualifications with a large number of lenders. And so we've actually had an internal tool that we've been using for quite some time that allowed us to underwrite for about 10 or 12 different lenders. We're actually changing and tweaking this tool, and it's going to qualify and underwrite for every single lender inside and outside the broker channel, and for every single one of their products. So their standard program, a net worth program, corporate net income program. This tool is going to be huge, and it's taken, I think we might be up to 1,000 hours of manpower to develop and create all the programming and math behind it. We're going into beta testing very, very soon in about 1 or 2 weeks, and we will be letting our clients know once this is finished. If anybody wants to evaluate their portfolio to see if they can qualify for more, or if they can qualify to restructure some of their debt, we'll be able to have our clients fill in this worksheet and send us very minimal documentation. And with that, we'll be able to look at the entire marketplace for our clients and see what options they have to restructure their debt or to buy another property. So we'd love for you to be involved in that testing if you do have a need or a want to understand what your options are. So stay tuned for some information. You can also reach out to us if you wanted to get some more information on that. And last but not least, what our clients are doing right now, given this information, a lot of them are increasing their HELOCs. A lot of them are parking their money into short-term investments like private lending or mix, because so far looking at real estate hasn't been as attractive, although I'm starting to see that shift where people are a little bit more interested in owning the real estate again, as opposed to just lending on it. Getting pre-approved to take advantage of opportunities. We're starting to see some opportunities out there. There's going to be some motivated sellers that are in a pickle, and if you're ready to take advantage of that and close, then that could be really good for you. And then making that decision, either riding at the variable or taking a short-term fixed rate. And for a while there, it was very obvious that just taking a short-term fixed rate makes a lot of sense. Now it's a bit more complicated. If the Bank of Canada starts to decrease rates faster than expected, it might be actually better off to ride at the variable. I still think that maybe looking at locking you into a short-term fix may make the most sense, but it is something that should be considered. So if you wanted to understand more, book a consult with us today. We're happy to dive into this and give you some more feedback and information. For those of you that don't know, I am a best-selling author. We wrote Rockstar Real Estate Investing, and is all about how to invest in real estate, all of the fundamentals of how and where and what to buy, etc. So if any of you would like a copy of that book, please just email us at info@greenmortgageteam.ca. We'd be happy to send you a copy of the book in the mail. Just make sure you let us know what address we're sending it to, and we'd be happy to send it over. Maybe what I'll do now is I'll open it up for some questions. I think there was one in the chat, so I'll start to go through that now and answer that question. So Mark is asking, if the US Fed rate increases rates this month, Canada might have to increase in order to preserve the Canadian dollar and not cause more inflation. Yes, very good point, Mark. So there's a lot of talk about the US Fed likely not increasing the interest rate, but if they do, Bank of Canada and the US Fed don't always have to move in lockstep, but they often do. And one of the reasons for that is, even though our inflation is starting to get under control, if the US interest rates rise too much respective to ours, what ends up happening is more investment floods into the US because their rates are higher. And if more money floods into the US, it actually pulls their dollar even higher. So higher interest rates versus ours means higher dollar compared to ours. And a higher dollar means that it affects our imports and our exports. A higher dollar is generally good for our exports, but bad for our imports. It costs us more money now to buy goods. And that then has an impact on inflation. So we'll be able to sell more of our commodities, which means that there's more money coming into the country from that perspective, but it costs us more to buy goods. And those two factors happening at the same time actually could cause more inflation, which is not good. It's something that we're actually trying to get under control, as opposed to get more out of control. So good point, Mark. Thank you. Any other questions? Leave a question in the Q&A. I'm happy to answer any questions you guys have. I've got another question here. So when 65% loan to value max HELOC takes effect, if my HELOC is currently 80%, do I have to pay it down immediately down to 65%? So that's our understanding, Alan, is that that what will end up happening is the bank will just say, okay, we have to select a portion of your loan and it has to go over here. And now as you pay down this section of the mortgage, it would not automatically increase your line of credit. It's just the portion of your loan that allows you to re-borrow the principal you've paid down on that portion. So you do not have to pay down your mortgage considerably. And Susan asks, is there a chance to have our portfolio evaluated? Yes, so that's something that we're going to be able to do from a mortgage perspective anyways. I will say that my real estate investing consulting company does do evaluations for portfolios, and that's something that we'll be sending out some more information on soon, because we do have an event actually coming up on April 15th. So stay tuned for more information on that, Susan. But from a mortgage perspective, just to restructure debts, we'll be able to do this with our new tool that we're developing. We do have a different tool that we've been in development as well that allows us to look at the return on investment from different rental properties, and that's a bit of a different analysis altogether. Any other questions? Anything else you guys had some questions about? Any thoughts if government has a change in government soon? I'm not going to get political, John. I don't know the answer to that. Let's just put it this way: I wouldn't be surprised. I think a lot of people are unhappy with the way things have gone the last few years, but it's hard to say. So yeah, it's a tough call. Thanks, Mary. Nice to see you. What's your guess for the new minimum down payment when it changes? My guess is probably 25% down. So that's what I would expect, anyways. I don't think it'll go to 35% down. I think that's aggressive, but 25% I could see that happening. Judy asks, can you say something about the underused housing tax? Not much to say here, but it's coming back to the same thing, which is the low supply. The government's trying to address the low supply issue, and if people are sitting on houses that are completely empty, then they really don't like that. So that's something that they're looking at. Deirdre, so the question is, are these changes coming in June? The HELOC changes are coming in June. That's the one that we know is happening. All of the others, we don't know. They may happen, they may not happen. There's been a lot of talk about it, and I wouldn't be surprised if at least one of those changes does happen. But the problem is that a lot of the time these changes come and then you have very little time to act, especially in the minimum down payment. And so this is something that we may see come down the pipeline. Yeah, minimum down payment is the one that would be, if it comes out, they'll probably give you very short notice and say, okay, this is on existing contracts, or if you write an offer within the next 30 days, then it'll be honored. So it's something that could come out and be very quick. And no changes to amortization, and they're unlikely to change amortization. So the question about bond rates affecting mortgage rates. Yes, so bond rates have an impact on fixed mortgages because mortgages are lent out to people like you and me, then they bundle them up together and then they sell them. And this bundle of mortgages can be purchased by international investors, the same as a bond could be. So it could be bought a mortgage-backed security, or you could also buy this as you could buy a bond. They're all kind of a similar asset class. Fix and flip. No changes to fix and flips. Nothing really changes on that side of things. So we're not expecting any changes there. Awesome. Well, maybe what I'll do now is I'll finish up the webinar. Thanks so much for joining. If you have any questions, just reach out to us, info@greenmortgageteam.ca, or you can call us at 604-229-5515. Thanks for coming out, and we'll send you over a copy of the recording as well. Thanks a lot, guys. Bye now.